Good evening, and I'd like to welcome you to our 2011 Stock Market Outlook entitled Still Bullish Despite the Challenges. Okay, so to start with this presentation, I'd like to share with you this quote from Warren Buffett. It said that, be fearful when others are greedy and greedy when others are fearful. So today, well, if there's one thing that you should remember is that you should be greedy today and not fearful. So I will convince you why you should be greedy. And second, I will provide you with an investment plan that will allow you to capitalize on this rare opportunity. Okay, well, first and foremost, I'd like to share with you why there has been a sell-off in the market. So first, we have inflation and interest rate fears. And second, there's a shift back to developed markets such as the U.S. Okay, well, these two slides will just show you why we have inflation fears. So as you can see here, the CRB index, which basically displays it's a composite of numerous commodity prices. Well, they have really been going up. They've been going up for more than a year already. And in fact, I think it is most reflective on oil prices here in the Philippines. No? So I'm sure you felt it in your transportation costs. And well, the interest rate hike fears are apparently there. As you can see, 10-year bond rate, all of a sudden, after plunging to around 6%, has jumped back to around the 7% level. So clearly, there is this fear that, with rising commodity prices, we would have to raise interest rates. And also, of course, all this news coming out from China that they're raising reserve requirements, raising interest rate from China, tightening in the Asia-Pacific region. So all of those talks are creating this fear in the market. Okay, aside from that, we have these developments in the U.S. Funds are flowing back in the U.S. and why is that? So we did some research and well, in summary, there's this growing evidence that there will be no double dip in the U.S. Remember last year, everybody was asking, are we going to have a double dip in the U.S.? That's a major risk. That's why we don't want to be invested in the market because there might be a double dip. Well, the good news is there won't be a double dip, but the bad news is, of course, it has hit our markets. So what has happened? First, around the late October, early November level here, during that time frame, the U.S. announced the QE2 or quantitative easing 2. Essentially, they are going to take measures that will lead to a further expansion in the money supply, encouraging banks to increase the lending. Aside from that, they want the US dollar to be weak to promote the expansion of exports. Then next, around early December, the US administration or the Obama administration, together with the Congress, agree on stimulative tax policies. So essentially, the expansionary tax policies of the Bush administration will be extended for another 2 years, and they will implement other tax policies, which economists estimate will add another 0.5% to US GDP growth. And then for this January, better than expected economic numbers have been coming out, lending support to this argument that there is no double dip recession. So I just like to share with you some economic numbers out of the U.S. Okay, U.S. real personal consumption expenditures were up by 2.8% in January or in December of 2010. So this is the fastest growth since January of 2007. Then we have the ISM manufacturing index. So essentially, the only thing you have to know about the ISM manufacturing index is that if it's above 50, it means that manufacturing activity in the US is picking up. And as you can see from this chart, it's not only above 50, it has actually been accelerating, and it is at the highest level since May of 2004. So that lends support to the argument that there is no double dip in the US. Okay, but we believe the sell-off will be temporary. So the reasons why we think it will be temporary include the fact that we expect interest rate hikes to be minimal. Fundamentals of Asia, including the Philippines, are better than that of the US and developed countries. And we're currently in the midst of an investment boom. And finally, valuations are not expensive. Okay, why do we think interest rate hikes are going to be minimal? Well, first, we don't have a bubble yet. So usually, central banks increase interest rates aggressively when they are trying to control the bubble. Pictures speak 1,000 words. So if you look at this picture, I don't think you can say that there is a bubble when people are actually not borrowing money. Loans to GDP are just at 33%, clearly on a downtrend. Loans to deposits, 64%. That means for every peso that you put in the banks as deposits, they've only lent out 64 centavos, which is why they're only paying you 0.5% for your savings deposit and 2% for your time deposit because they don't need your money. People are not borrowing. So how can you have a bubble when there's no greed and people are not borrowing money? Okay, so I don't think interest rates are going to go up in a big way if that is the situation. Okay, then on inflation, okay, this is not as clear as the other charts, but the point is we have a very strong balance of payment position at 4.9% of GDP. BOP, or balance of payment just measures the amount of dollars that come in relative to the dollars that flow out. So as you can see, the balance of payment position has been on a strengthening mode since 05, 06, 07. The major reason why we have a strong balance of payment position is because right now we have strong OFW remittances. So a lot of dollars are really coming in. Well, unfortunately for those that still have a lot of dollars right now, this would inevitably result to a stronger peso and a weak dollar. So an appreciation of the peso. On the good side, a stronger peso would make imported products cheaper, such as commodities, oil. If we import rice, it's going to become cheaper. Therefore, if we can buy all these commodity products and imported products at a cheap price, that would actually combat inflation. So concerns about inflation will be addressed or partly addressed by the stronger peso. And then finally, I would like to share with you the Bangko Sentral overnight borrowing and lending rates. As you can see here, the overnight borrowing rate is at 4%, while overnight lending is at 6%. Well, clearly here you can see that since 2002, these rates are at very low levels. Okay, what does that mean? Well, in case you have forgotten, the reason why they are where they are is because the government or the BSP actually cut them aggressively because they wanted to stimulate the economy in 2008. So inevitably, they will have to bring it up to more normalized levels. Okay, but nevertheless, let's say they increase the rate. They increase the overnight lending rate from 6% to 7%. You can see that it's still below where it was in 05, 06. So remember, we had a bull market from 04 to 06, and even if they increase rates back to 7%, that's still not a lot. I think a bull market can still take place even with overnight lending rates at 7%. Okay, well, this one seems to be mayabang, but you know, for the first time since I have been born, I'm proud to say that the Philippines is better than the US. And these numbers will speak for themselves. If you look at GDP growth forecast, okay, ASEAN 5 is like 5+%, US 2.3%, Euro area 1.5, 1.8. I mean, well, the most bearish analysts right now are saying 2011 GDP growth for the Philippines is 5.5%, 5%. Okay, but what is the speed of the growth in the other countries? In the US, it's 3%, and they're actually happy with it. So, if you look at that, we're still better off in terms of growth. We're going to be growing faster. Okay, and what else? Well, if you look at these other economic health indicators, which are the debt to GDP, deficit to GDP, okay. Obviously, well, the Philippines has a lot of debt, but it pales in comparison to that of the US at 83.3%, and to that of Europe, which is at 74%. Our debt to GDP is only at 56%. Okay, deficit, yes, the press has been talking a lot about our ballooning budget deficit. But if you look at the deficit of the US and the deficits of Europe, it's nothing. It's only a third of the deficit of the US and half of the deficit of Europe. In fact, while we're anticipating the deficit of the country to actually drop, the deficit of the US will actually go up in 2011 because of all those tax cuts, all the fiscal stimulus of the Obama administration. So essentially, they want to grow the economy today, and they'll just think about it tomorrow of how to address this problem of the deficit. Okay, going forward, what will drive the growth of the country? Well, we believe that we're in the midst of an investment boom. Okay, there are numerous investment opportunities in the country. As you can see, investments to GDP are or have been on a downtrend since peaking during the Asian financial crisis. So currently it's at 16%. For other Asian countries, especially for the developing Asian countries, the level of investments to GDP is actually around 30 to 40%. So I mean, you have 15 years of underinvestment. So that means there really is a lot of potential out there. What has changed? Well, as you can see, business confidence has picked up substantially following the election of the Aquino administration. So we are quite hopeful that that will be the catalyst. And so far, so good. This one shows you that investments have actually picked up during the past 4 quarters. So the Philippines just released the 4th quarter GDP for 2010, and surprisingly, it was very strong. We ended the year with a GDP growth of around 7.3%. And one of the major drivers is investments. Investments were up by 23% during the 4th quarter after showing signs of slowdown. So there's a lot of pent-up demand. People have a lot of money. Interest rates are very low. What was needed was a lot of confidence, which wasn't there prior to the Aquino administration. So with that in place, investments have started to pick up, as shown by this capital formation chart. Okay, going forward, the Aquino administration is saying that they will launch numerous PPP projects. So for 2011, there will be a lot of infrastructure projects, a lot of tourism projects in terms of airports. Total value is estimated to be around $2.4 billion for 2011. But from 2011 to 2016, they've identified $17 billion worth of potential PPP investments or public-private partnership investments. Okay, so we're quite hopeful that this will actually drive investment growth in the country.